If you've been watching the charts this week, you are probably feeling a strange, uh, palpable tension. On one hand, the price action is just fragile. Bitcoin is really struggling to defend that critical $90,000 psychological fortress. It feels like the market is walking on eggshells.
It absolutely is. And that tension you're feeling. Well, that's the market focusing entirely on short-term liquidity. And it's completely ignoring the fact that the underlying infrastructure is accelerating at a historic pace. We have to look past the daily candles and into the architecture being built right now.
Okay, let's unpack this. Our briefing today screams one fundamental contradiction. We have money running for the exits, yet the government is simultaneously building the on-ramps.
That is the core thesis. That's what's defining this moment in Q1 2026. We are witnessing a definitive divergence between immediate tactical liquidity conditions and long-term structural entrenchment. The market narrative right now is institutional capitulation amidst sovereign infrastructure expansion.
That's a powerful framework. So our mission today is to cut through that noise for you. We are in what the sources are calling a cleansing phase. We need to understand why the so-called smart money is signaling extreme caution, right now, even though the regulatory bedrock is being laid down faster than ever.
Exactly. We're going to trace that short-term fear, analyze the technical support levels that must hold the floor, and then pivot quickly to the massive federal and geopolitical moves that suggest this asset class is rapidly becoming, well, too integrated to fail.
Let's start with the immediate market dynamics then, the tactical retreat, because the price action has been entirely driven by institutional risk management. The biggest signal, the one that pulled the rug out, it came from the most important player in the ETF space, BlackRock.
And what's truly fascinating here is the psychological shift. For the first time this year, BlackRock's IBIT was not the buyer of last resort. It flipped. In a single session, IBIT switched from being that reliable source of daily inflow to a net seller. It shed nearly $200 million.
And that single action immediately triggered contagion. That one pivot led to a broader, what was it, a $1.1 billion exit from the entire spot ETF complex over just 72 hours. So the key question for you, the learner, is this. Is this a fundamental rejection of the asset, or is something else driving this rapid de-risking?
Our sources confirm this is classic, pure tactical risk management. Hedging. Institutions are de-risking ahead of binary macro events. We're talking about the potential fallout from non-farm payrolls data.
Which always creates volatility.
Always. And the massive looming Supreme Court decision on tariffs, which could shake global supply chains. When the largest asset managers, like BlackRock and Fidelity, suddenly decide to hedge by selling, the entire market loses its floor because that reliable demand just evaporates.
And we saw the tactical fear immediately infect the high beta side of the market. Let's look at the alt ETF space. US spot XRP ETFs recorded their first net outflow day ever, pulled $40.8 million, concentrated heavily in 21 shares TOXR EPF.
That is the market telling us exactly how institutions view altcoins. It confirms they are treating alt ETFs purely as high beta trading vehicles. They are volatility plays. The moment the big money gets nervous about Bitcoin's macro exposure, they exit the more volatile products first. They're signaling the party is temporarily over.
Okay, looking at the technical picture, the sell-off took us right past that critical $92,000 pivot level, which invalidated the immediate breakout thesis we had been tracking. The intraday low dropped all the way to $89,240, setting off a cascade of stop losses.
Right. The market is currently consolidating, but we need to identify the absolute must-hold zone, the level that prevents this tactical correction from turning into a structural downtrend. That zone is the $88,500 to $89,100 area.
Let's translate that for those who don't spend their day charting. What makes that zone so critically important?
It's what we call a confluence zone. It means multiple significant trend indicators are stacking up in the same narrow price band. Specifically, that's where the 50-day moving average, which represents the market's midterm momentum, meets the top of the Ichimoku cloud, which is a comprehensive system tracking major trend support. If we see a daily close below that $88,500 threshold, the entire structure shifts from a healthy correction to a major regime change. That's the line in the sand.
But even with $1 billion rushing out the door, we have a profound counter-narrative from Wall Street. JP Morgan released a research note arguing that the structural de-risking is likely over. How do we reconcile BlackRock selling today with JP Morgan saying the long-term selling pressure is exhausted?
This raises an essential question about the nature of the risk being taken off the table. See, JP Morgan is looking at long-term structural overhangs that haunted the market last year. They focused specifically on the fear that the MSCI index might reclassify crypto holding companies, which would force massive index funds to liquidate billions in assets. But since MSCI chose not to implement that specific exclusion, JP Morgan's thesis is that those potential forced structural sellers are now exhausted.
So institutional fear is now purely tactical macro calendar anxiety, not a fundamental belief that the foundational infrastructure is unstable. In fact, that foundation is getting stronger by the day.
And that brings us perfectly to the other side of the contradiction, the structural advance. While traders worry about defending $90,000, the federal government is moving to integrate this asset class deep into the U.S. financial architecture.
And here is where it gets truly transformative. We're witnessing the sovereign banking singularity unfold. World Liberty Financial, or WLFI, a project our sources suggest has strong ties to the executive branch, is seeking a national trust bank charter from the Office of the Comptroller of the Currency, the OCC.
This is an absolute game changer for stablecoins. WLFI intends to use this federal charter to issue, custody, and redeem its USD1 stablecoin directly under the federal banking umbrella. Crucially, this is a direct, aggressive play to bypass the friction of state-level regulation like New York's restrictive BIT license.
It sets up the first major Fed-blessed competitor in the stablecoin space, built for institutional trust.
And it's not just about stablecoins. It revives the concept of the narrow bank model. For you, the learner, a narrow bank is one that accepts deposits and facilitates payments, but does not engage in fractional reserve lending. This makes it inherently less risky to regulators. A successful charter for WLFI would set a massive precedent. It would immediately clear the path for established crypto firms like Kraken or Coinbase to seek similar federal status, accelerating their full integration into the traditional banking system.
Meanwhile, the U.S. Treasury is formalizing compliance requirements via the Genius Act. They're not just talking about regulation, they're building an automated compliance stack.
Exactly. The Treasury issued a formal request for comment, an RFI, which signaled their focus. They are asking for industry feedback on using sophisticated tools like artificial intelligence and digital identity verification to detect and prevent illicit activity.
The implication for the entire ecosystem is clear. Future regulatory compliance is going to be automated, instantaneous, and extremely sophisticated.
This is regulation as a competitive advantage. Only large, well-capitalized incumbents, the BlackRocks, the Coinbases, can afford to build these compliant automated stacks. They require immense AI development and legal budgets. This creates a massive, insurmountable barrier to entry for smaller, decentralized, or privacy-focused projects. The system is being built to favor the giants.
And finally, we have the major legislative showdown in the Senate. Senator Boozman, the chair of the Senate Agriculture Committee, is finalizing new text for the long-awaited crypto market structure bill and intends to force the vote on January 15th.
This is arguably the single most important regulatory catalyst institutional investors have been demanding for a decade. The bill's goal is simple: grant the CFTC primary jurisdiction over Bitcoin and Ether. This effectively strips the SEC of its ability to regulate these two core assets via enforcement, providing the definitive regulatory clarity the market has desperately needed to fully unlock institutional capital.
So we have the fear that causes BlackRock to sell $200 million today. But the federal government is simultaneously preparing to grant a major bank charter, and the Senate is pushing a landmark bill defining the legal future of the market. The divergence is truly stunning.
So let's look at why that immediate tactical fear might be justified, not just by macro events, but by internal ecosystem strain and external geopolitical threats. We have two major internal fractures this week. First, the governance crisis at Zcash.
Yes, the entire engineering team of the electric coin company, the ECC, resigned en masse due to fundamental, irreconcilable differences with the nonprofit board.
This is a textbook mission versus market conflict playing out publicly. The departing team immediately formed a new for-profit startup called CashZ. The developers argued the nonprofit structure stifled capital raising and innovation, while the board insisted commercialization threatened the core privacy ethos of the protocol.
The result is a fork in the development roadmap for one of the oldest privacy protocols. It creates confusion and uncertainty at a time when privacy coins face existential regulatory threats under the Genius Act standards we just discussed.
And if governance failure wasn't enough, we had a catastrophic security failure to reinforce the risks. The Truebit protocol suffered a massive smart contract exploit, resulting in the theft of $26.5 million in ETH.
And that caused the TRU token to crash over 99%. This is a brutal, high-profile reminder of the complex, often hidden risks inherent in DeFi, compared to simpler, spot-based, fully audited assets.
This whole sequence, governance, chaos, and security catastrophe, it validates the institutional flight to quality. Why would you risk capital on complex, unaudited protocols when BlackRock is offering a simple spot-based ETF wrapped in federal regulatory approval?
That brings us to the most significant external risk, statecraft. The recent Chainalysis 2026 Crypto Crime Report paints an alarming picture of where illicit volume is moving, and it's no longer just individual scammers.
What stands out here is the complete shift in scale. Illicit volume, totaling $154 billion in 2025, is now overwhelmingly driven by sanctions evasion and statecraft. North Korea and Russia are using crypto at an industrial scale to bypass the traditional SWIFT system and to fund military objectives.
The regulatory consequence of this report is massive. It will be used immediately to justify extreme, aggressive KYC and AML measures globally. The direct result for institutional holders is the necessity of rigorous taint analysis checks on their holdings.
Taint analysis, right. It means checking the transactional history of every single Bitcoin you hold to ensure it hasn't interacted with known wallets tied to sanctioned regimes. Because of this existential threat from state actors, we are now seeing a forceful market bifurcation.
It is forcing a clear distinction between clean Bitcoin and gray Bitcoin. The industry is being forced to choose.
Exactly. And that risk is why institutions are perfectly justified in tactically selling the moment the macro wind shifts, even while the fundamental infrastructure is being built.
So despite this tactical fear and these internal struggles, infrastructure is being built rapidly, especially outside the U.S. Let's look at how Tether is playing global defense.
Tether, the issuer of the world's largest stablecoin, just signed a strategic cooperation agreement in Vietnam to establish G98 digital asset JSC. And Vietnam is a hugely crypto-native economy where USDT is already widely used for commerce and remittance.
This is much more than just a simple business deal, it's geopolitical strategy. Tether is cementing USDT as the de facto reserve currency of the developing world. It's creating a massive defensive moat against U.S. regulatory overreach, the exact kind of aggression we anticipate as WLFI prepares to enter the ring with its Fed-blessed stablecoin.
This confirms two parallel financial worlds are being built. One is heavily regulated and compliant under the U.S. flag, and the other is a more robust, globally oriented system centered on USDT designed for the emerging world.
Meanwhile, we're seeing the institutionalization of increasingly sophisticated yield strategies right here in the U.S. Look at SharpLink Gaming, which deployed a significant $170 million worth of ETH onto the Linear Layer 2 network.
They are far beyond the initial simple cold storage model of corporate treasury. They are engaging in complex, enhanced yield strategies. Their stack involves native staking, restaking via sophisticated protocols like EigenLayer and Ether.fi, and leveraging L2 token incentives.
The implication is clear. This marks the institutionalization of DeFi risk, albeit in a managed way. It supports the narrative that large corporate treasuries expect their crypto assets to function like any other asset. They must generate cash flow to justify their volatility and inclusion on the balance sheet.
Their CEO termed this the start of Ethereum's productive era. It's a massive shift from crypto being viewed merely as a speculative store of value to a cash-generating enterprise asset.
And finally, a quick note on the seemingly boring but critically important regulatory evolution. NYSE Arca filed to list the #Bitcoin ETF under generic listing standards Rule 8.201-E.
This is the moment when Bitcoin ETFs become boringly normal. Removing the need for bespoke, time-consuming SEC approval for every minor product change simplifies the process significantly. It signals the complete normalization of the asset class. It means Bitcoin ETFs are now treated legally and logistically much like gold or oil ETFs, fully integrated into the traditional financial system's plumbing.
So let's synthesize the core contradiction for you. We have a $1.1 billion tactical sell-off driven by fear of the macro calendar, causing massive short-term price anxiety. Yet the federal government is simultaneously preparing to grant its first major national trust bank charter to a stablecoin issuer. and the Senate is pushing a landmark bill that institutional investors have demanded for 10 years.
The short-term fear is intense, but it is fundamentally ignoring the long-term structural inevitability. So what should we be watching for in the immediate future to gauge whether the correction is over?
We need to see if those ETF flows neutralize or reverse. If BlackRock's IBOT or Fidelity's FBTC turn neutral or positive in the next 24 to 48 hours, that suggests the tactical flush is complete and money is starting to flow back in. Also, watch closely how the market digests the NFP employment data and that looming Supreme Court tariff ruling. Those are the last two major binary events, keeping significant institutional money on the sidelines.
Ultimately, the market is in the process of becoming defined by what kind of money holds it. We discussed the Chainalysis report and the industrial-scale use of crypto by sanctioned regimes, forcing that hard market bifurcation.
Exactly. As the asset class matures and integrates deeply into the sovereign financial systems, the question for you moving forward is this. How will the growing mandated demand for clean Bitcoin, that which is fully KYC'd, traced, and ETF held within compliant financial rails, ultimately affect the fungibility and the final pricing of gray Bitcoin? The mixed, private, or possibly tainted Bitcoin circulating outside those regulated infrastructures.
It's the difference between infrastructure and purity, and that distinction is only going to get sharper. We'll continue the deep dive next time.